Okay, so liquidity is simply stop loss orders, and the only reason these markets move is for liquidity. Now, the reason why that is because it allows smart money, big banks, big hedge funds to get in and out of their positions, because where there are stop loss orders, there's going to be money. So to determine liquidity, what we do is we get on the 4-hour chart. Now, you can use the daily, the weekly, and even the monthly, but to be honest, just use the 4-hour chart. We have to use a higher time frame because that gives us the overall direction of the market, or a bird's eye perspective, if you would like. But you get onto the 4-hour chart, and what you do is you simply ask yourself which major high or low is price most likely to go for. So right now in price action, we're at this point here. So you're going to ask yourself, right, you're going to look to the left hand side of the chart. Is price more likely to come up and take out this high here, where there's lots of stop loss orders at, this high here, or is price more likely to do this? Is it more likely at this point right here to come all the way down and take out this major low here, right? Which one is more likely? Hopefully it's pretty obvious, right, that price is more likely to come up and take out this high right here, or these highs right here, right? Price is right next to it. There's no respect of any bearish order blocks, bearish fair value gaps, right there. So what does that really mean then? What does that really mean? If we're at this point on the charts, we know that price wants to go for these highs here. What does that mean? It means one simple thing. It means we are bullish and the markets overall are bullish. So the highest probability trades are going to be looking for longs. Now at this point here, we get onto the lower time frames, or our entry time frames. Okay, so now that we've got our direction, we need to wait for a liquidity sweep. Now what a liquidity sweep really is, it's just a stop run. Now you might hear a liquidity sweep be called a liquidity purge, grab, run, and ICT calls it a Judah swing. Whatever name people want to call it, the reality is it's simply a stop run, right? It's a fake move in the opposite direction of the overall market. Now, really important here, the only reason liquidity sweeps actually work is when you've got the overall direction. Now, if you remember from the beginning of the video, this is our 4-hour liquidity right now. If you zoom all the way out, you'll find the high all the way over here. But this is our target. This gives us our direction. Now, can you see how price is right here? It's ready to go up. It drops massively. It takes out stop loss orders here, here, and here, which is also London's low, so the previous session's low. And then it quickly and aggressively shoots off in the opposite direction. That right there is a liquidity sweep. And the highest probability trades always occur after a liquidity sweep. Super important. If you do not wait for a liquidity sweep, you will see your stop loss get hit, only to see price then go to your take profit. And it's very annoying, and it held me back for 4 years, right? 4 years I could not make money because of this liquidity sweep. Now, the easiest way to spot a liquidity sweep is to wait for a stop run, right? So we see these lows here. We've got one low here, one low here, one low here, which is also London's low. So wait for the sweep, wait for price to come and take out stop loss orders, and then wait for a fair value gap to form in the opposite direction, because that right there will give you, that right there is smart money literally screaming at you once this fair value gap forms right here. Once this fair value gap forms right there, that is smart money screaming at you that this is a liquidity sweep, this is a fake run, a fake move, and that price is quickly and aggressively going to reverse in the opposite direction. Okay, but last but not least, all we need now is a simple entry. We have our direction on the higher time frames. We have our liquidity sweep, which should always be on your entry time frame. If you trade the 1 minute chart, do not wait for a liquidity sweep on the 1 hour chart. It must always be on your entry time frame. Now, the reason for that is the only reason we wait for liquidity sweep is so we can put our stop in a safe area. So for your entry, you can use literally any entry pattern, any indicator that you want, assuming you've got the direction, which we use on the 4 hour chart, and you have the sweep. Once you have those two, any entry pattern will do. You can use the fair value gap. The stop loss is quite large here because the stop loss must always be at the liquidity sweep low, which is really just this low here, right? The fake move, the low that causes the fake move is here. It should always be fixed at this low here. There is no point waiting for a sweep if you're going to put your stop all the way over here. The only reason we wait for a sweep is so you can find a high probability place to put your stop loss. So you can enter using the fair value gap and target, whatever you want to. The stop loss is quite big here. So for me personally, what I use after 5 years of trading, the only thing I still trust after, obviously having the direction and the sweep is a simple Fibonacci optimal trade entry, retracement, whatever you want to call it. I enter at the 0.705 level here, just so I don't have to guess what fair value gap, what order block I can take. And I simply enter here, like this, stop always at the liquidity sweep low, and then I simply target a 3 risk to reward ratio, like that, and we hit it like that, and you will see this right here is the highest probability setup you will find in all of trading, and I can honestly say that after 5 years. Find liquidity on the 4-hour chart, that gives you your direction, wait for a sweep on your entry time frame, and then look for any simple entry pattern. If you do that, I guarantee you, you will become profitable more faster than you could ever imagine.